This video is going to touch on the 3 key cash flow management strategies. So last video introduced cash flow management and the importance of cash flow management. And this video will introduce the 3 key cash flow management strategies in the context of the overall financial management strategies that are important and may be utilised within a business. So those 3 cash flow management strategies are the distribution of payments, a discount for early payment, as well as factoring. So firstly, the distribution of payments. Well, what does that actually mean? Cash flows of a business are going to fluctuate constantly. The cash inflows and the cash outflows are going to vary over time. And it's important to manage those payments to ensure that the money that's coming into the business is appropriate and sufficient that the business can pay the money that needs to go out of the business, so that it's effectively matching its accounts receivable with its accounts payable. And like I said in the previous video, really at the end of the day, a business would like to get its accounts payable paid to it its accounts receivable paid to it as quickly as possible, so i.e. its debtors, and pay its creditors, i.e. its accounts payable, as slowly as possible. And that's what distribution of payment is partly about. So as you can see there, a business can manage possible shortfalls, so cash shortfalls. So what that really means is it isn't getting enough cash into the business to be able to pay the cash going out of the business. So it can manage that by a couple of different things. Number one, its first choice might be to delay payment of those accounts payable or those creditors. So try to potentially negotiate a longer term to pay those accounts payable. It might also look to pay those creditors in installments. So ask them, rather than paying all of it in 30 days, could we pay some of that payment every 10 days? We'll give you some of the payment via an installment, and then ultimately you'll get all your money and it will space out the accounts payable that the business is making. Potentially also the use of effectively a budget, so cash flow projection, forecasting the amount of money that's going to need to be paid at certain dates so the business can then manage its cash inflow to ensure it has appropriate funds to be able to make those cash outflows. And lastly, some monitoring and reviewing so that the cash outflows are actually minimized. Essentially though, the first 2 points are probably the most pertinent. Delaying payment of accounts until they're actually due, so that if you've got a 30-day term to pay off your account, wait until day 29 to pay it. And secondly, paying installments might be a possibility, and requesting that from the party you owe that money to. So that's the first cash flow management strategy. The second one is a discount for early payment. So a business can improve their cash flow by offering discounts for early payments of their credit sales. So for those businesses who owe the business money, so the debtors to the business, a business might offer a discount if they pay early. So for example, here is your, send the account to the relevant party. You owe us this money, this account must be paid within 30 days. However, if you pay within 14 days, we will give you a 5% discount or a 10% discount. So you're trying to incentivize those debtors, so those parties who owe you money that are on your balance sheet as an account receivable, you're trying to incentivize them to pay early. And in doing so, you're going to give them some reward to try to incentivize them. Discounts could be just a numerical figure like I just stated, or it could also be scaled, as this third point says. So that the earlier the repayment, the bigger the discount. So pay within a week, we'll give you 20% discount. Pay within 2 weeks, we'll give you 10%. Pay within 3 weeks, 5%. And then pay within 4 weeks, you won't get a discount for paying that outstanding account. And one of the important things about that cash flow management strategy is that by receiving that cash early into the business, it's able to use that cash to run the business. So better it to be in the pockets of the business as opposed to its stakeholder, who could be its supplier or whoever it is who owes the business that money. The last strategy is factoring. So factoring, if you remember back to sources of finance, it is a short-term debt source of finance, but it's also a strategy that a business can undertake if it's having poor cash flow, because it can sell its accounts receivable at a discount to generate cash. And if you remember back to that part of the topic, we said that often that cash can be received within 48 hours. So you're getting that cash quickly and you're overcoming a cash flow management problem. And that's going to help the business by providing with cash to meet those short-term obligations, and it should help it to overcome any liquidity issues that business might have. So they're the three key cash flow management strategies: distribution of payment, factoring, and discount for early payment. And the next video will focus on working capital management strategies.